When it comes to passive investing, the Nifty 50, the Nifty Next 50, the Nifty Midcap 150 and the Nifty Smallcap 250 are the frontline choices. Together, they represent companies across the market cap spectrum and hence form the bedrock of any vanilla passive strategy. But a natural question that arises is in what proportion you should invest in these indices. Should you allocate equally among them? Or should you go heavy on Nifty 50 and the Nifty Next 50, which comprise comparatively larger companies? Or does it make sense to invest more in mid and small caps so that you can get higher returns? Hello and welcome to ET Money's YouTube channel. In this video, we'll tell you the best combination for a vanilla passive portfolio that has Nifty 50, Nifty Next 50, Nifty Midcap 150 and Nifty Smallcap 250 as its constituents. So if you have a passive portfolio or are planning to build one, the insights from this video are going to be very important. So do watch it completely. Now what sets this video apart is the intensive background calculation. We will analyze the performance of various passive portfolios, not just for 5 or 10 or even 15 years, but for the last 20 years. That's the maximum period possible, as the data for Nifty Midcap 150 and the Nifty Smallcap 250 is available only from April 2005 onwards. What's more, we'll analyze portfolio performance for both Lumpsum and SIP investments. So this will provide you with time-tested and reliable takeaways that are not affected by a particular market phase. This video belongs to our playlist on passive and factor funds. To watch more such videos, you can explore it. The link is in the description. Okay, let's start this video with quickly discussing the methodology that we followed. But before that, here is something important. Many of you come here for the kind of mutual fund analysis you rarely see elsewhere: rolling returns, downside protection, and so on. But knowing how a fund behaves is one thing. Figuring out how to use that information in your investing decisions can be difficult because each of us have our own risk comfort and goals. That's exactly why we built ET Money Select. It's a personalized shortlist of funds that stand out from over 2,000 plus mutual funds, not just on returns, but on how consistently they deliver and how well they protect when markets fall. The list is personalized to your risk appetite and gives you funds for short, medium, and long-term horizons. And for every fund, you get a simple note explaining how it invests and what drives its performance. Plus, an alert if the fund starts to dip or a better alternative is found. So do check it out. Alright, now this analysis is divided into two parts: SIP and lump sums. For lump sum calculations, we considered the daily levels of the TRI variance of the four indices: Nifty 50, Nifty Next 50, Nifty Midcap 150 and Nifty Smallcap 250 over the last 20 years. For SIP calculations, we considered their monthly levels for monthly SIPs over the last 20 years. Now, since there were no passive funds with a 20-year history for mid and small cap indices, we decided to create proxy funds for each of the four indices. To do so, we assigned an NAV of 10 each to our four proxy funds and changed their NAV as per the changing levels of four indices over the last 20 years. In other words, our proxy funds simulated the movements in the four indices perfectly. Now do note that in real life, passive funds do have a tracking error. This means they don't perfectly copy the movements in the underlying indices. We then use the NAVs of these four funds to make investments in three combinations. First is the balanced combination, in which equal amount was invested across all four proxy funds, that is 25% in each fund. Second is aggressive combination, in which 35% of the investments were allocated to each of the Nifty Midcap 150 and the Nifty Smallcap 250 and 15% to each of the Nifty 50 and the Nifty Next 50. Third is the conservative combination, in which 35% of the investments were made each in Nifty 50 and Nifty Next 50 and 15% each in Nifty Midcap 150 and Nifty Smallcap 250. Now for a lump sum, we considered an investment of 1 lakh made across these funds in various proportions 20 years ago. For SIPs, we considered an SIP of 10,000 per month made across these funds in varying proportions. Units in the fund were allocated as per the prevailing NAVs. In both cases, the portfolios were rebalanced annually and the desired portfolio allocations were restored. We then compared the pre-tax returns and the volatility of the three portfolios. Okay, let's first take a look at the performance of the three portfolios: balanced, aggressive and conservative in case of lump sum investment made 20 years ago. First, let's take a look at the worth of 1 lakh in the case of each of the three portfolios: balanced, aggressive and conservative. As expected, the aggressive portfolio generated the highest corpus of 19 lakhs. The balanced portfolio resulted in about 18.5 lakh and the conservative portfolio managed to deliver 17.7 lakh. Still, what's noteworthy is the difference in the corpus generated by the balanced and conservative portfolios versus the aggressive portfolio. The shortfall in the balanced portfolio is just 3.33% of the size of the aggressive portfolio. For the conservative portfolio, it's 7.4%. Now, this suggests that while the aggressive portfolio did better than other two, the outperformance isn't substantial. To further analyze this behavior of the three portfolios, we calculated NAVs at the portfolio level. Now, the movement of the NAVs of the three portfolios clearly depicts their overlapping wealth creation trajectory. From these portfolio level NAVs, we calculated the rolling returns and the volatility of these returns. Since 5-year is the classic recommended period of equity investments, let's compare the average 5-year rolling returns of the three portfolios along with the volatility of those returns. To arrive at the average 5-year rolling returns, we averaged all 5-year return samples between 2005 and 2025. On a 5-year rolling return basis, the aggressive portfolio had done the best with an average return of 14.4% per annum. The balanced portfolio has generated 14.1% per annum and the conservative portfolio 13.8% per annum. Again, the return differentials aren't wide. Okay, let's now check the volatility of these rolling returns. For that, we will use a metric called standard deviation. The higher the standard deviation, the greater the portfolio volatility. Now, on expected lines, the aggressive portfolio has exhibited the highest volatility and conservative portfolio has been the least volatile. However, the difference in the volatility between the aggressive portfolio and the conservative portfolio is quite high. The aggressive portfolio has proved to be as much as 25% more volatile than the conservative portfolio. Even the balanced portfolio is 12% more volatile. Overall, it's safe to conclude that while the aggressive portfolio does deliver higher returns, it does so amid a relatively higher volatility. Now, the risk-adjusted returns of the three portfolios tell the same story. To arrive at the risk-adjusted returns, we divided the average 5-year rolling returns of three portfolios by their volatility measured in terms of standard deviation. The higher the risk-adjusted return, the better the performance. Now, against this metric, the conservative portfolio has done the best. Now, would this picture change in case of SIPs? Well, let's find out in the next section. But before that, do subscribe to this channel if you aren't already a subscriber. And don't forget to press the bell icon so you never miss a video from us. Like the lump sum analysis, let's first compare the final corpus generated by the three portfolios with a monthly SIP of 10,000 rupees and annual rebalancing frequency. Here also, the aggressive portfolio has done the best and generated a corpus of 1.48 crores from SIPs of 24 lakhs. The balanced portfolio generated about 1.41 crore and the conservative portfolio delivered about 1.33 crore. In percentage terms, with respect to aggressive portfolio, the balanced portfolio delivered about 5% less and the conservative portfolio 10.3% less. That's not a wide gap. Now, the relative movement of the NAVs of the three portfolios paints a similar picture, with the three portfolios moving more or less in tandem. If we calculate the SIP returns for the three portfolios, there isn't much difference between them. At 15.9% per annum, the aggressive portfolio has the best return profile. At 15.5% per annum, the balanced portfolio comes second, and at 15% per annum, the conservative portfolio is at the third place. To assess the volatility of these three portfolios, let's take a look at the standard deviations of the 5-year rolling returns based on their monthly NAVs of the three portfolios. Like the lump sum case, in SIPs 2, the aggressive portfolio exhibited a much higher volatility than the conservative and balanced portfolio. To put things in perspective, we can check the risk-adjusted returns of the three SIP portfolios too. Like the lump sum investments, here too, the conservative portfolio has the best risk-adjusted return profile, followed by the balanced portfolio and then the aggressive portfolio. Now, what do these observations suggest and what should you do? Let's discuss that in the concluding section of this video. In this video, we compare the long-term performance of three portfolios, each comprising four frontline indices, the Nifty 50, the Nifty Next 50, the Nifty Midcap 150 and the Nifty Smallcap 250. Now, we did so both for lump sum investment and SIPs. In terms of returns, while the aggressive portfolio performed the best, its outperformance over the balanced and conservative portfolios wasn't substantial. However, the aggressive portfolio exhibited notably higher volatility. Now, what's explained this? Well, if you look at the annual returns of the four indices, we can notice the periods when a particular index did well. For instance, the Nifty 50 did better in 2005, 2006, 2008, 2010, 2011, 13, 18 and 2022. Similarly, the other three indices also have their periods where they did well. As such, no one index does well at all time. That's why the performance of portfolios that have all four indices tends to converge. Now, what explains the wider difference in volatility then? Well, mid and small caps are more volatile by their very nature. Portfolios that are heavy on them suffer deeper drawdowns and this raises their volatility. Now, a deep drawdown also limits the return potential of portfolios heavy on mid and small caps as they need to bounce back higher to recoup their losses. This is another reason why the returns of aggressive, conservative and balanced portfolios converge. First, avoid going overboard on mid and small caps in search of returns. You can achieve decent investment outcomes even with a balanced or a conservative portfolio. Second, if returns are a top priority for you, be prepared to tolerate higher volatility. In difficult times, don't shun your strategy or lose hope. High returns and high volatility are two sides of the same coin. Third, avoid writing off a particular market cap if it hasn't been doing well. Different market caps do well in different market phases, so maintain your exposure across all. Fourth, be disciplined and invest for long term. Rebalance your portfolio at appropriate intervals to restore the desired asset allocation. This point can't be understated. With the long term, investment discipline will prove to be a bigger differentiator than your choice of indices. Regular rebalancing will also help contain portfolio volatility as you would consciously shift away from the market cap segment that has run up and hence can experience greater volatility going ahead. And with this, we have come to end of this video. I hope you found it useful, and if you did, please don't forget to share it with your friends and family. I'll be back soon with another video. Till then, take care.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.